Dr. Shubhada Rao, Senior President and Chief Economist at Yes Bank, is now joining us to help us decode those numbers. Dr. Rao, thank you very much for being with us here today on NDTV Profit. It's a pleasure to have you on the show. So the confusion continues. Are we growing or slowing?
Quite right. Is it a confusing phase for us? Clearly, the numbers as represented by the IIP lead us to believe that growth is still elusive. We are still looking for a sustainable trend in growth. The February numbers were positive, so broadly the momentum, we thought somewhat, was indicative of growth getting supported, particularly if you look at the proxy indicators, be it the auto numbers that came in for March, or the PMI that came in for March. Exports growth-wise were not great, but in absolute terms were 2 billion higher. So overall, the lead indicators or proxy indicators did seem to suggest that growth will be showing a better print. However, belying expectations, we were at a 2.6. So considering that a 0.1 was a serious disappointment. The usual culprits, I would think, capital goods. Now 5 consecutive months, we have seen a negative print. Now that is somewhat worrying because while we all know that private capex is not anywhere, picking up, but the government-led capex is definitely, at least from the fiscal numbers we see, has been showing a pickup, but that is not getting reflected, anywhere in the capital goods number in IIP. The consumer non-durables is another story which continues to remain disappointing, which also shows that a broader consumption basket is on a weaker turf, a rural economy in particular. But having said, if you disaggregate the data, sugar alone, the output because of the drought conditions was seriously affected, and the decline in sugar output alone was responsible for 106 basis point decline in IIP or in consumer non-durables. So overall, I think, growth continues to remain elusive. We will hopefully see some, lagged impact of monetary policy easing that we have been seeing now for over 12 months. Also, somewhat of seventh pay commission impact or the positive impact if the monsoons prevail well. I think all of these should, going forward, hopefully should get supportive of growth. But at this point, definitely March number has disappointed in a big way.
Right, so a big disappointment out there. Manufacturing contracted in this month as well. But looking at the core sector data that we saw for the month of March, that came in as a big positive surprise. We had the April PMI numbers coming out. What do they really tell you? Do you think this trend, this low growth trend is going to continue, stay here for a couple of months more?
I would think for the growth to pick up, we will have to probably wait until next 1 or 2 quarters. What we see is, all of the factors that I talked about earlier could weave into growth and into headline numbers starting the 3rd quarter. Now, we have been saying this for some time, but, we have had random factors, playing kind of a dampener role in growth story to get better. But at this point in time, if I aggregate the positives in terms of the impact, lagged impact of monetary policy, the policy environment getting better, the bankruptcy code getting cleared, so some appetite hopefully. So these are a play for more, over a period of time. We could probably have to wait out over the next 1 or 2 quarters for the headline numbers to show better in terms of growth. As I said, capex led by the government should have a positive multiplier going forward. As you rightly said, some of the core segments have been doing well, of which I would really like to point out one segment called electricity. Electricity has had a very decent run in the recent past, in the recent 3 or 4 months. In March alone, we saw 11% growth. So quite clearly, we need to connect the dots going forward and see that how the core, sector does play a feeding role into broader manufacturing sector growth. Cement dispatches, cement production has not been too disappointing. We have seen fertilizer on the agriculture side doing better. So core overall has done a tad better. All of this should prevail and pave way for broader growth within the manufacturing sector going forward. So just wait and watch is what we are at the moment doing. But tracking the proxy indicators and some of the lead indicators, we believe that growth should improve going into the second half for sure.
So the third quarter is now something that we have to be optimistic about, at least for now. Ma'am, talking about the inflation number, that has inched up thanks to the spike in food inflation that we've seen. How worrying is that seen right now, considering, now many are saying that the drought-hit areas which are there in the country, till we see good showers coming in, they are going to just aggravate this entire situation?
Quite right. I think 5.39 was well above the market consensus, though I would like to add that we were at 5.39 in our forecast. So in terms of inflation expectations for the print, we were right there. And typically, if you see, the month of April is the starting point of the price momentum building up related to the monsoons. Related to the summer season. So as expected, the perishable items had seen a significant pickup of 4.77. We also saw a small pickup in protein items like meat and fish, where the pickup was slightly less at 1%, below 1%. But very clearly on the food was one of the key drivers. As far as the services inflation is concerned, we did see an uptick, in the fuel-led transportation item within miscellaneous. That had also risen, and that was well along the expected line. What is somewhat worrying is some of the other services inflation items like education, which remains significantly sticky at around 5% plus. Now, these are the things, as RBI had also commented on, need to be watched out for. Having said, I think, is it going to be such a shocker for RBI? Perhaps not, because if you look at the monetary policy report and the fan chart that RBI presented for the year, and also stated thereafter in the monetary policy statement, a 5.3 is what RBI expects around June of 2016, and that is precisely because of the seasonal nature of the price momentum. Now, yes, of course, if in May we see a further significant uptick from 5.39 upward, that would be worrying, because if May sees another equivalent or slightly more than what we saw in April as a pickup, it would be difficult to imagine that kind of correction coming into the monsoons, starting June, July. Although I would like to add that IMD has predicted earlier onset of monsoon. So all depends actually a lot on how well the monsoon arrives and how does it progress. So that feeds us into a call of what RBI would do in June, on June 7th. Earlier on, we had made a call of rate cut on the last rate cut of 25 basis points on June 7th. We do have two risks on this call, which is, of course, that IMD final forecast may be disappointing. If it is not disappointing, if it only gets better, the risk gets relatively muted.
So you were telling us, Dr. Rao, that a 25 basis point cut is something that you're still expecting on 7th of June?
If not 7th June, at least the first half, maybe in August. As I said, it would all depend on how RBI perceives this commodity space, as well as whether it waits out until the full monsoon gets delivered by July and early August. Would that give complete confidence to RBI? But on the flip side, we have global elements like a Brexit waiting down some on 23rd June. So if there is indeed a Brexit, would lead to a fair amount of market volatility. That would narrow down the possibility of RBI wanting to cut rates. But if in perception of RBI that growth still needs a support by additional rate cuts, and if inflation is moving along the expected trajectory, it had actually, talked of intra-quarter variations. And this is one typical quarter where the price momentum does build up. So if RBI considers this as one which is along the expected lines and the monsoon is likely to get better, then why not June 7th is our, position that we continue to hold. But as I said, these are the elements that would depend largely on how RBI perceives these two elements, and it could be anybody's guess whether it's June or whether it's August. But if I were to be asked that is there a rate cut at all in the year, I would say that yes, we are definitely looking at a 25 basis point rate cut additionally from what we saw a policy ago.
Right. So, but that big dilemma, of course, is going to be there for the RBI governor, because on one hand, growth is slowing down, and second, inflation is rising. In terms of the trajectory for food inflation, you said that the current increase has been because of the seasonal, factor. Going forward, where do you see inflation heading, say, by the end of calendar year 2016?
I think more than calendar, we are projecting our inflation to be at 5% by March. And the reason is, while we do see a pickup now, if the monsoon is very good and the distribution of monsoon, more importantly, is better, then definitely it sort of has a salutary impact on, inflation expectations, and the trajectory could actually reverse and get lower. Now, if all of this is playing out, then our estimate at this point in time continues to remain at 5%. For March 2017, and that's what is also RBI's estimate. So we continue to hold that estimate as of now. Early days yet to review the forecast.
All right, Dr. Rao, thank you very much for joining us here on NDTV Prof. It's always a pleasure to have your views on the various macro indicators for the economy. Thank you for joining us today.